Hey there, everyone. Welcome to Chart This with Dave Keller. Happy Monday, April 28th. Welcome to the show. My name is Dave Keller. I'll be your host today, coming to you from a kind of overcast, but still pretty nice Redmond, Washington. Hope you guys are all doing well. Enjoyed Monday's sort of V-shaped day as the market, I think, waits with bated breath. Bated breath. That was a nice Freudian slip. Bated breath is what I meant to say. Waiting for big technology and communications earnings coming through the course of this week. We've got four of the Magnificent Seven stocks reporting earnings on Wednesday and Thursday. A huge number of S&P 500 companies reporting through the course of this week. Today, a couple, but not a big day. Really starts tomorrow through Friday. And then Friday, you've got some energy companies, Exxon and Chevron, the two big integrated oil companies. So it feels like, certainly, as much as we've talked about earnings season being a key potential driver this week, a lot to think about. Certainly, a lot of individual stocks to evaluate. So, honestly, I feel like by Friday's close, we might have a different feel than we do today about overall market conditions. Part of that is a bunch of earnings. The other part would be inflation data, jobs data, all of those economic numbers. The PCE number comes out on Wednesday. That's the Fed's preferred gauge of inflation. So as much of this as this rally has been pretty impressive off of the lows, today with a V-shaped day, certainly not giving the bears a lot of love. Whereas, around lunchtime, it felt like this was going to be a big distribution day after last week's incredible run. Not to be had, and going into the close, a nice upside move. So end of the day, the markets didn't move directionally a whole lot from Friday's close to today's close, but they did move. So let's look at the charts together, see what we can see, and then I'll take your questions as always. And thanks for tuning in live, those of you that are doing so. So end of the day, you can see this V-shaped day today. This was Friday's rally going into the weekend in a position of strength. Today, kind of opening a bit stronger. Low around 1:30 p.m. Eastern, rallying in the afternoon. That makes the S&P essentially unchanged. I'm talking 3.5 points difference from Friday's close to today's close. We'll call that basically an unchanged day, about 0.1% higher to 55.28 and a little left over. The Dow was up about 0.3%. The NASDAQ slightly lower, about 0.1%. Mid caps and small caps both up about 1/3% today. And the VIX actually drifted a bit higher, although earlier in the day, the VIX was getting up around 27 by the close, kind of back toward the lows of the day. So again, VIX around 25 is basically not low. That'd be a VIX below 20. It's not high. That'd be a VIX above 30. VIX between 20 and 30 is kind of a neutral one, right? Kind of a wait and see day. And that makes sense that the volatility would be kind of around that area. Given the uncertainty going into earnings this week, inflation data, et cetera, the other things I mentioned in the introduction. So with the VIX around that level, around 25, that basically means days like this are pretty rare, or at least that's what the market is telling you. More common would be big percentage swings to the upside than the downside, much like we've experienced here so far in the month of April. Looking at the bond markets, you can see that the TLT was actually up about 0.5 point. So that's about 0.6% to the upside. Kind of a nice, slow and steady gain type of day for the bond markets. This is moving yields higher. So you can see the 10-year yield right around 4.22. Long bond yield right around 4.7%. The 5-year yields pulled back to almost 3.8%. So rates drifting lower here. We'll look at the chart of the TLT. I think I grabbed that for the chart review portion. You can see, maybe sort of rotating low, kind of a rotating off of the lows, and maybe a bit stronger here. We'll see what the week provides, but you'll see what I mean. Looking at a bit of a rotation higher off of recent lows. Dollar index, a bit of a downward draft through the course of the day today. A lot of people have been talking about the dollar. We certainly have as well in terms of measuring non-U.S. investors rotating into U.S. dollars to buy U.S. assets. We did get a bit of a strengthening of the dollar last week as the equity markets were rallying. Today, dollar rotating back lower and kind of drifting lower through the course of the day. Gold getting back to its bullish mojo. The GLD is around 309 at the close. That's up about 1.4%. Gold's been chopping around a little bit, and I've had a lot of questions recently from some of my premium members, also on the chat in some of our shows here recently, talking about whether gold is in a correction I mean, the short answer is no. Gold is not in a correction. Again, I mean, the words correction and pullback, I mean, I think are thrown around pretty loosely to describe general behavior. I'm not of a kind of hard and fast opinion that if it's, down 19.5%, it's not a correction. But if it's down 19 or if it's down 20.01%, all of a sudden it's a bear market. I think those are just sort of placeholder kind of names to describe what's happening. The way that I would look at the chart of gold, it's pulled back within a long-term uptrend. Our market trend model, if you apply it to gold, bullish on all timeframes still. So I don't think nothing to be too concerned about just yet. For now, continuing to go higher, up 1.4%, silver up about 0.5%, copper prices higher. Crude oil is the only one of these major ETFs. That's not true. Gasoline, corn down today, but crude oil down a bit, even though the energy sector was number one out of the 11 S&P sectors here. All right, finally, cryptocurrencies, a bit of a mixed results here today. Over the weekend, Bitcoin generally kind of drifting higher, although from Sunday now into Monday, sort of a choppy, noisy 24 to 36 hours, as you can see on the preview chart on the left. Bitcoin currently around 94,450. So we've powered above the resistance around 91,000, continuing to push to the upside, 0.7% higher for now. Although again, pretty choppy session for Ether, for Ripple, for Solana, for a lot of these on the top 10 list. Kind of a choppy period here. All right, let's look at the 11 S&P sectors. Pretty good news in the fact that 9 out of the 11 S&P sectors finished in the green today. But the stuff at the top of the list is not kind of that feel-good growth trade that we experienced through all of last week, right? The story of last week was growth over value. If you look at the ratio of like a growth ETF versus a value ETF, look at like the Russell 1000 ETFs, for example, growth has been underperforming value year to date. Over the last week, rotating right back up as growth stocks really had a pretty decent week. A lot of the FANG stocks obviously having ridiculously strong weeks after a period of relative weakness. Of course, that's going into earnings this week when honestly all bets are off. I feel like could be obviously quite a bit of movement going into, probably more coming out of those earnings releases. For now, you're going to note it's not the FANG sectors at the top of the list. Energy number one, up 0.7%. Real estate and utilities basically second and third, both up about 0.6% today. On the downside, only 2 of the 11 S&P sectors were in the red. Consumer staples down about 1/3%. Technology down 0.2%. Then you've got consumer discretionary basically flat for the day here. So for now, again, choppy session, but in terms of directional movements, the growth stocks that have been dominating everyone's thinking last week, kind of not following through. And I'm not surprised if there's a bit of a wait and see trade happening with those FANG sectors as we go into a fire hose of technology earnings and communication earnings. On Wednesday, Microsoft and Meta both reporting, Qualcomm, KLAC as a semiconductor name. On Thursday, Apple, Amazon, obviously in consumer, MicroStrategy, MSTR, all reporting here on Wednesday and Thursday. So quite a bit of earnings to make sense of for now. That sector kind of flat to slightly down. The breadth was not great, although it was sort of mixed through the course of the day. It fluctuated quite a bit. Earlier in the day, it was tilting a little more negative. By the close, you can see 2/3 of the S&P 500 stocks closed higher, so that's good. Same for the mid-cap index. The NASDAQ, a little more even between stocks up or down. The New York Stock Exchange, which is probably the broadest universe that we're looking at here, 61% up, 36% down. So overall, not a bad day breadth-wise. Breadth indicators generally have been improving. The McClellan oscillator has been above zero here, certainly for the last week, a little bit more than that. So you're certainly seeing that short-term breadth really start to rally. Some of the breadth indicators arguably getting a little bit overheated. We'll look at the bullish percent index on the NASDAQ 100, above 70, which actually suggests overheated conditions. As of Friday's close, by the way, our market trend model did turn bullish on the short-term time frame. It had been bearish since the February peak, essentially. So we're back to this sort of short-term rally within a medium-term downtrend, within a long-term uptrend. So I don't know if you could come up with a more confusing structure to lay out on my market trend model. That's pretty much what it looks like. The tactical time frame, the short term, you're seeing these bounces off of the early April lows. certainly enough of a bounce to call it at least a recovery rally, if not the beginning of something more significant. One of the ways that I would determine whether it's something even more significant with upside potential beyond what we've seen so far would be the medium-term model turning bullish. That has not happened yet for me. The long-term model is still overall bullish, which says that that secular trend is still okay. But that's where we're at here. Again, going into a busy earnings week. Looking at the FANG stocks, you can see kind of mixed results, right? So Netflix up about 0.8%. That's been by far the best of this group of basket of stocks. Meta and Apple both up about 0.4% today. Tesla, which had a remarkably strong week last week, dribbling higher about 1/3%. On the downside, if there's any, something to pay attention to, NVDA down just over 2%. I mean, not a bad chart, but I mean, certainly not a good chart, I would say, when you look at it. And, nice bounce, but still making a pretty clear pattern of lower highs and lower lows, perhaps. We'll look at the chart together here in a moment, see what you think. All right, we're going to bring up the heat map here and continue our discussion. As a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X. And I appreciate you so much tuning in live. Those of you that are doing so, pop questions in the comments on whichever of those platforms you're watching on. I can see all those comments here real time. I'll take a question or two at the end of the episode. Anything we don't get to, we'll put in the mailbag. And if you've missed the Friday mailbag episodes, I hope you can go back and review them. They've been really, really good. On Friday, we spent a good amount of time on the Zwag breadth thrust because I had a bunch of questions on that. Thursday into Friday, so talked a little bit about the nuances of that particular breadth indicator and some really other thoughtful questions as well. So keep the great questions coming. I appreciate it so very much. All right, let's look at the heat map here. I mean, so NVIDIA obviously stands out in the upper left corner as a sort of a negative outlier. This really was kind of a flat day. I mean, if you look, the average color here to me feels kind of neutral. Maybe, sort of literally like dead neutral almost, right? You've got some random things up a bit, some random things down a bit, but no big moves. I mean, last week, the average, day had a lot of green, particularly in the growthy sectors, particularly in the largest names. Worth noting, after that nice run, we take the weekend off, we come back, and Monday, Amazon down, Alphabet down, again, not end of the world down, but just not up. And so it certainly feels like that rally we saw going into the weekend for now, sort of on ice here until we get to earnings would be my guess. And now, again, that's assuming no big headlines coming. And as we all know, that is probably not a great assumption to make in 2025. So we'll just brace ourselves for the next hiccup that we're presented with. But for now, from a technical perspective, I see this as a market kind of treading water here. Some random names that are actually in the green, and I think areas to look at would be some of the defensive sectors. Consumer staples still probably the weakest of this group of 11 sectors, with some names down a bit more than you probably want. But I'm looking at the lower right, things like real estate, utilities, not a bad day. The relative performance in defensive sectors has rolled over in the month of April, after going into April quite strong year to date, outperforming most of the growth sectors. In April, we're actually seeing quite a bit of a rotation there, bit of a leadership rotation. So I think the relative performance of those defensive sectors, pretty key to watch. So days like this, if you can see more and more green in those sectors, that tells you maybe there's a rotation to more defensive positioning. I don't know if I'm comfortable saying that just yet. Looking at the returns today, it was sort of an unchanged kind of day. Finally, in financials, we've got some financials reporting here. A bunch of them reported earlier in the season, but Visa in particular is coming up. I think that's tomorrow. I think that's on Tuesday. PayPal is on Tuesday. Is that true? Yeah, PayPal's on Tuesday. Pretty sure Visa's tomorrow too. I did grab that chart. We'll look at it here in a moment. But I would say some of those earnings names, obviously pretty important to watch. Financial stocks generally have been pulling back here over the last 6 weeks. And the question is, do we regain moving averages? Do we break to new swing highs? That's what we've not seen. That's what we've not seen yet. A lot of earnings. So I hope you're following an earnings calendar somewhere. What I use, by the way, is Koifin, which is what I was glancing down here. This is one of the ways that I use this platform, is looking for the earnings calendar, just getting a sense of who's reporting when. Stock Charts has a decent earnings calendar. A lot of other ones, FinViz, I think others have them. So again, this is a really good time if you don't have a good way of tracking in your portfolio or with your watch list when companies are reporting earnings. today would be a great time to get that all locked in before we go through this this week here. All right, let's continue on and look at the charts. By the way, though, before we get there, I do want to let you know that my next presentation that you may be able to access is coming up this week. I'm going to be doing the Money Show Virtual Expo that's coming up Tuesday and Wednesday of this week. I will be speaking on Wednesday, April 30th. I'll be doing a presentation called 5 Key Lessons Learned Over 5 Years Interviewing Market Experts. I've basically taken all these podcast interviews and episode interviews that I've done over the last it's almost 6 years now that I think about it, and boiled it down to 5 key takeaways, kind of common investing, lessons learned from all those people. So if you're looking to stretch your thinking a bit, join me for that event. You can get more information at marketmisbehavior.com/money show. And again, that's a free virtual event coming up Tuesday and Wednesday of this week. A lot of other great presentations as well. This is my old school headshot. I think that was when I first spoke at Stock Charts. I had that one. I have a little more facial hair and a little more gray than now. That was a little more in the salt and pepper stage for Dave, but it's still going to be a good presentation. So hope you can join me there. Again, marketmisbehavior.com/money show. Hope you can tune into the event there. All right, let's look at the daily chart of the S&P 500. So on Friday's episode, we answered a bunch of mailbag questions and also looked at this chart to talk about just some, general takeaways going into the weekend. Again, my main, weekly market analysis exercise goes into my weekly flight plan, which I release for all my premium members over the weekend. So we dug into some of these themes a little more in a little more detail. But I would say the key with the S&P 500 on Friday was closing above that trend line. That purple trend line takes the key highs from February and March. You can see that lines up pretty well with where we were on Friday. We closed briefly above that level. Today, the question is, do we get follow through? Bit of a concern if there's any today. This is a doji candle, kind of the open and close right around at the same levels for the SPX. I haven't looked at other indexes. I don't think there was this doji-like, but that's what jumps off the page of me right now. It usually suggests indecision and most likely a brief reversal for 1 to 3 bars for what it's worth. For now, I think when we break above 5,500, which we did on Friday, and the fact we're remaining above that level, that's kind of the support, right? We did trade below it intraday and then closed back above us. That's pretty encouraging. I think the S&P above 5,500 is kind of neutral. I think the S&P above 5,750 is pretty bullish. I think the S&P below 5,500 is not so bullish. And so where we're at the end of this week relative to that level could be the story. And as much as this has been a really good rally, I mean, now we're making a higher low in last week in April. We're bouncing off of those levels, the gap higher midweek, and then we rotate higher. I mean, that's all pretty encouraging in terms of the upside follow through. So now we're kind of in that neutral no man's land between 5,500 and 5,750. I think anything breaking above there, pretty encouraging. And I'm not the only one hanging in on some of those levels. If you listen to my podcast interview with Jeff Hughes, which was on Thursday of last week, really good conversation. I would encourage you to check it out. We talked about a lot of different things, but talked about his sort of downside objectives for the S&P, which are pretty low. And in his opinion, right, getting above the 200-day kind of negates that. Tells you if we get above the 200-day, I'd have to totally reconsider the bearish thesis. And I think that's a great way to think about the structure that we've seen in the markets here recently. And again, I mean, one of the things that you have to deal with anytime you're investing is you're going to be wrong a lot. So identifying what your thesis is and then figuring out what would tell you you're wrong. What would you need to see to change your positioning is super important. So I think the S&P over 5,750, you'll hear me get a much more bullish sort of way of describing the market activity, because I think the weight of the evidence at that point, most likely pretty positive. For now, I'm seeing a nice rally into kind of the neutral range here. I'm seeing the momentum still not great. In a bull phase, you'd want to see the RSI get a lot higher. The fact that it's remaining kind of close to 50 means there's just not a lot of big momentum up days. There's still a lot of distribution happening, which is exactly how this market feels to me. It really is kind of a choppy, sit on your hands kind of market, to be honest, is how I would describe it. Now, the breadth conditions definitely have been getting better, and that's one thing I would not deny at all. The New York Stock Exchange Advance Decline line, which is this top series, I've color-coded neutral amber because it's back above the 50-day moving average for the first time since the February peak. Now, the advanced decline data, if you look, did not make a new high in February, right? So the S&P was up here, making a new high, and the advanced decline line is actually making a clear lower high. Its all-time high was back here around Thanksgiving of last year. It was one of the great, many kind of bearish divergences we saw going into that February peak. Things like advanced decline data not confirming the uptrend. Now, all of these series, except for the S&P's advanced decline line, made a new low for the year in April. And now all of them, except for the small cap ones, are back above the 50-day moving average. So I consider that kind of neutral breadth. We start breaking above these the March peaks, which is not too far off. I think the breadth starts to look a little bit even more constructive. We'll see what happens here. But for now, certainly the bounce higher in breadth from early April to late April is pretty encouraging. Now, some of the breadth indicators in terms of short-term breadth has gotten so strong, it's actually contrarian bearish now. Here's the percent of NASDAQ 100 members that are currently in a bullish point and figure profile. Back here, second week in April, as the market's bottoming out, it was around 6%. Only 6 of the 100 NASDAQ 100 stocks were in a bullish point and figure signal. As of today, that number's up to 73%. And so what that means is over half of the NASDAQ 100 stocks have given a buy signal on their point and figure chart in the month of April. And so that's certainly a big swing back to more of a bullish breadth reading. However, it's not above 70. It's now above 70%. If you look back to previous times when we've ticked above 70%, particularly when we start to rotate back below 70%, that's where we often have one of these tradable peaks and at least a brief pullback of sorts. It's not perfect. So there are times when we kind of get above 70%, stay there for quite some time, and it's quite bullish. But more often than not, those overextended signals often lead to some sort of pullback. So I think the NASDAQ 100 now on pullback watch after the bullish percent index pushes above 70% for the first time really since the February market peak. We'll keep an eye on that one through the course of this week. I think earnings could be a catalyst which causes that indicator maybe to suddenly shift gears. We'll see. Now, I talked about bond prices moving higher today. Here's the chart of the TLT. You can see that we bounced off of a level around 85. That's pretty close to the low that we saw at January before rallying up to around 94 to retest the December peak. Now we're kind of right back to the 50-day moving average, really mid-range from where we've been in 2025, from a low around 84 to a high around 94. Here we are at 89 and change. So we're literally kind of in the midpoint. The momentum overall is still negative, right? So the RSI is remaining below 60. So I think pushing higher with the RSI moving above 60 would indicate a likely upside breakout. For now, it's sort of wait and see. Again, mid-range. So a lot of the charts I'm looking at, they're kind of neutral, right? I mean, that's the best way I would describe it. It's not bearish. It's not like we're making a new low. It's not super bullish. We're not breaking out. We're kind of in the middle of a range that we've set. And that's kind of where the conditions are right about now. Now, Bitcoin, I would say one of the few charts really having an inflection point from the April low and clearly breaking back above moving averages, clearly breaking out above the March high. This is what we've not seen on the chart of the S&P yet, right? The S&P is still kind of below that March high. Here we actually see a chart breaking with authority above that March high here in the last a week and a half or so, continuing to drift higher. I think that's a strong chart now starting to get higher. I'm watching I'm looking back to the previous highs. I think that's most likely where we eventually test from here. There's no real resistance on the chart up until that point. That's kind of the general sense I would have here. So nice breakout and follow through after this bullish divergence that we had going into the April low. I mentioned the defensive sectors earlier in the episode. We saw today some of those defensive sectors like utilities and real estate at the top of the return list. You can see here the 4 defensive sectors on a relative basis compared to the S&P 500. So from the top, we have utilities, healthcare, consumer staples, and real estate. Each one of these is the relative performance of that sector versus the S&P 500. So year to date, we can see that all 4 of these sectors have been outperforming the S&P. Now, there's been a bit of a change here in the last week as we saw those follow-through up moves from some tech leadership names, from a lot of mega cap growth names, the Magnificent Seven and similar names having these nice strong weeks last week, outperforming while these sectors start to underperform. This is an important one to watch because one of the key, I think, signals that we saw coming out of that February peak was the fact that all these defensive sectors really started to outperform. It really spoke to a rotation of sorts from offense to defense, from risk on to risk off. And if that changes, and if the relative performance of these sectors continues to go lower, that would tell me that investors are rotating out of these defensive sectors and into where. And that's where you have to look at traditional kind of cyclical leadership like energy and materials. You have to look at growth sectors like technology, consumer discretionary, and see where we're seeing the rotation. But I think that would be very much a change that we've not observed really so far in 2025. All right, let's look at some individual names. Netflix making a new all-time high today. As we close every show, it's always a good time to own good charts. Netflix is a good chart, and how do we determine that? What's making higher highs and higher lows? It's above two upward sloping moving averages. The RSI is strong, which means strong momentum. The relative performance is strong, continuing to move to the upside. Now, we're overbought, right? We're getting into that overbought condition. Now, before you get all negative on Netflix just yet, remember, here is where we got overbought after that breakout. Right here is where we got overbought there. And in both of those last two overbought conditions, we ended up drifting higher for a couple of weeks to a month before making the eventual top. So just becoming overbought on its own is usually not a bad sign. Divergences are usually a bad sign. Rotating out of that overbought condition with breakdowns of some sort, that's more of a negative sign. So keep an eye on this one. For now, still okay. And I think overbought means up a lot. That means the stock has gone up a little bit. We want to follow those uptrends as long as possible. As Peter Lynch said, we want to water our flowers and pull our weeds. Don't do the opposite. All right, looking at Apple, we talked about this last week going into this trend line on Friday. We closed above trend line resistance today. I mean, what I would probably call a doji candle, which is where the open and close are right around at the same level. I mentioned that on the S&P as well. You know, some of these stocks not really following through, right? Thursday, Friday, big up days. Today, kind of opening higher, but kind of chopping around here. So sort of at the very least telling you wait and see, indecision, no clear bullish follow through after last week. And on the chart of Apple, we're testing that resistance from that swing high earlier in the month of April. DELL is an example of the types of charts that have been incredibly strong off of the April low. And I had some questions on this over the weekend. Again, is this a nice move off of the lows? It is. Did it go from 66 to 94? It did. The problem is when you've had a stock that's sold off so aggressively, big snapback rallies are going to regain a lot of ground, but they're still going to be in a negative technical profile. The reason why I would call this a bearish technical profile is because we're still right at the 50-day moving average, which is sloping downwards. The 200-day moving average is sloping downwards. The RSI has gone higher, but is stalling out around 60. So this still looks like the type of chart that's rallying into resistance and not one that's completely rotating. And so that's the problem I have with a lot of these charts. The bounce off of the lows, yeah, I'd be thrilled to buy something at 66 and sell it at 94. I don't think I would be disappointed with that. But do I see anything on the chart now telling me that's obviously the beginning of a huge recovery? Like, no, not yet. And that's where I think you need to use good discipline to determine, all right, it still looks like a rally within a downtrend. What would tell me it's more than that? And that's improving momentum. That's breaking above 100, which would clear the March high. It's those follow-through signals that would tell you it's not just a bounce, but something more significant. I still think something to prove there with the chart of DELL. NVDA, kind of the same story. Again, nice bounce off of the April low, but it's still kind of below that that peak around 114, 115 from early April. The RSI is right at 50, which basically tells you up and down days are kind of even. The momentum is even between up moves and down moves. So this is neutral in terms of the technical configuration. It's not bullish yet. And if you made me have to pick between bullish or bearish, I would say bearish because it's still below two downward sloping moving averages. So if this market does turn into a raging bull market and we make a new all-time high in September and we just go up from here, at some point between now and then, I promise I will tell you, okay, this chart's not negative anymore. But for now, I'm not seeing that on the chart yet, right? I mean, the trend is still aiming lower by my read. Now, Tesla is really, really, really close to changing that to more of a bullish follow-through, right? If you look at the story of Tesla from the December peak, we're in a clear downtrend of lower highs and lower lows. We're then in a consolidation phase or a sideways range, ranging between 220 on the lower end and 290 on the upper end. That was the peak here in late March. That's where we're at today. Now we're testing the 200-day moving average. We're testing that late March high right around 290. That's where we're at right at the moment. I think Tesla above 300 is a bullish chart, and I will openly admit that and get excited along with all of you. If we get a push above 300, ideally the RSI pushes above 60. That would indicate an exit from this consolidation phase and into more of an accumulation phase. We're making higher highs and higher lows. We're just not quite there yet. I did have an alert set for 290. It triggered earlier today, but we didn't close above there. We kind of closed lower today. So I think still we have to wait to see if we get that confirmation. Alphabet, similar to some of these previous charts, breaking higher, trading up to the 50-day moving average and pulling back a little bit today. Again, I think these names are kind of treading water leading into earnings. All right, a couple other earnings names here to look for tomorrow. Today was not a big earnings day. There were some random names, but the fire hose starts tomorrow before the open. Tomorrow after the close, we have Visa. If you draw a trend line from the late February peak and the late March peak, it's pretty much where we're at this week as we also test the 50-day moving average. Now, this one's a little different because we bounced off the 200-day as we were oversold in early April. So that April low was right at the 200-day. And look at that beautiful bounce off of that 200-day moving average, which means overall, I think it's a pretty encouraging chart, really close to breaking above trend lines. Stronger momentum would certainly help that story. But overall, I think the chart of Visa may have nice upside potential if we can get a nice earnings beat tomorrow. Starbucks is another one. I think that's after the close tomorrow as well. Chart a little more neutral. This is really what I'd call a pennant pattern, which is when you have a sell-off, and then you have this sort of short consolidation, this little triangle pattern of lower highs and higher lows. Look at this hammer candle right as we form the lower part of that triangle. We're really close to breaking out of this pennant pattern. And what you really do in this situation from a technical perspective is wait to see which way we break out. And I'll show you what I mean by this pennant here. What you do is draw this kind of thing. I'm just going for speed, not for accuracy, but just so you get the idea. You kind of do this, right? So you have the big sell-off, lower highs, higher lows. At some point, this is going to break. That was a poorly drawn line, but you get the idea, right? At some point, we break above the upper boundary or below the lower boundary. And usually, whichever way we break, that's the direction of momentum going next. So for now, interesting chart. We'll wait and see what happens with earnings tomorrow. Not a bullish chart yet, but I think breaking out of that pennant pattern to the upside could complete it. That was a run through a bunch of names. Again, a lot of earnings stocks coming up here every day. We'll recap what we saw and continue to go on. Let's go through a couple questions or two. Eccentric CCC. Thanks for watching on YouTube. Yes, everyone's talking about the Zwag bread thrust. If I remember, I think you were asking about it end of last week as well. You said, do you think at this point it won't work anymore because everyone and their grandma are banking on it? I get that. I've gotten that question many times over my career. It's sort of that self-fulfilling prophecy question, right? I mean, if everyone's betting on some things, I mean, it no longer works. I have to tell you, though, I've spent a lot of time working with a lot of different investors, so many running big funds, never look at the Zwag bread thrust. They don't care about the Zwag bread thrust. If you tell them it's a Zwag bread thrust, their eyes will glass over. There is a subset of investors that are passionately into that. And depending on what you look at on your social media feed, it might seem like everyone's talking about it. Everyone is not talking about it. There are a lot of investors who will, on their deathbed, still not care what the Zwag bread thrust is. So I feel like with technical analysis, as much as certain things are widely followed, I still think a lot of investors, probably too many investors, don't pay attention to things like that. I don't think that would be the reason that the Zwag bread thrust doesn't work. What concerns me is if you look back, we talked about this on Friday's episode, so make sure you go back and watch that because I went through some charts to really look at some history and talk about some of those signals. But I will tell you that there have been a number of times in the last 20 years or so, a couple times where we've had that signal and then we end up making a new low. There's no guarantee that we just go up from there. I feel like with the Zwag bread thrust, that's sort of the base case until some other thing happens. And I think the problem with the market right now is you have these one-off events, the headline risk, as we'll call it, that can cause things to do something unexpected. With the volatility high, with all of that, I think noise and big movement is going to be harder and harder to separate from signal, at least for the foreseeable future. And so that's why, maybe the Zwag breadth thrust is more easy to trigger because of the volatility. That's certainly part of the argument. But we'll see if it works out well. Then I was totally wrong. The Zwag breadth thrust continues to be an epically valuable signal. Most of the time when that happens, markets higher 6 to 12 months out. If you look at the data again on Friday's episode, I went through that in a lot more detail. So I'd encourage you to check it out. Let's see. Mitchell, thanks for watching on YouTube. It worries me as Jeff Hughes, who was a podcast interview last week, that the S&P multiple is about the same now as it was before the depression of the 1930s. He showed the what was it? The CAPE right model that we talked about. Really fascinating chart. A number of the charts Jeff and I talked about, I thought were pretty interesting. His downside targets and the S&P, whether or not you agree with them, they made me think. And that's what I love so much about talking with someone like Jeff. He'll present a scenario, and whether or not you agree with it, I love how it stretches your thinking, gets you out of your comfort zone, and really think about, all right, what's possible, what's probable, how do I want to be positioned? I love conversations that help me get to that point. But I think his chart, looking at the multiples on the S&P, as much as we talk about, the market's down a lot, if you look at the valuations today, they're still pretty high relative to the history of the equity markets in the last 120 years. I will let you look at that chart in my podcast interview with Jeff Hughes, but I would say 100% agree with your take there. Someone asked about how do you become a premium member, and I appreciate you asking about that. Marketmisbehavior.com/premium is where you can get all the details on our premium memberships, virtual courses, custom or members only reports, and access to our members only community. It's a lot of fun. Would encourage you to check it out. Use the code YouTube when you check out for a good deal on your first 12 months on any plan. But I hope some of you would check that out for sure. Folks, that'll do it. I didn't get to all of those great questions. I saw a number of really good ones, but we'll add those to the mailbag, and hopefully on Friday's show, we'll get to a couple of those as well. For now, have a fantastic evening. Happy Monday. And remember, it's always a good time to own good charts. We'll see you tomorrow.